Before we start, let me give you a one-line warning that can save you years of regret. You might end up paying more tax than you need to, taking more risk than you realize, and losing control over cash flow exactly when your family needs stability the most. In next few minutes, I'm going to show you a clean, practical way to turn a lump sum into a predictable monthly income stream in India, using mutual funds without falling for common traps. So if you're an NRI, and you want your parents to receive steady money every month in India, this is your blueprint. Your dad or mom is retired. You have a lump sum sitting in fixed deposits. The interest looks okay, but TDS bites into it. The rates keep changing, and the cash flow doesn't feel that reliable. The question is, can we create something that behaves like a pension, that is money credited every single month, while keeping the principal relatively steady and tax impact sensible? Short answer is yes, you can. But we will do it in two phases so that you don't rush into a payout without building a strong base. Phase 1 is called the accumulation phase. Think of it as 3 quiet years where you let compounding quietly do the heavy lifting. You pick 2 or 3 conservative diversified funds that are designed to be steady rather than flashy. Balanced hybrid and dynamic asset allocation funds often fit this brief because they spread the risk across equity and debt and also adjust to market conditions. In this phase, the monthly distribution that the fund may declare, what used to be called dividends and is now called IDCW, are not taken out as cash. They are reinvested back into the fund. That reinvestment keep adding units to your name, which is the real engine here. See, NAVs or net asset values move up and down. Units are what you control. So more units accumulated today potentially become more cash flow later when you actually switch on the income tab. I want you to picture it. Suppose you invest a lump sum and the fund periodically declares a small per unit distribution. So when you select reinvest, the fund doesn't automatically send the money to your bank. It automatically uses that amount to buy more units at your name at prevailing NAV month after month, quarter after quarter, until your count grows. Of course, the market will have bad months. The NAVs might look sluggish at times, but that's completely okay. In the accumulation phase, you're not chasing that fancy chart. You're basically building a warehouse of units because later, income typically gets calculated per unit basis. So the more units you manage to accumulate in phase 1, the more monthly cash flow you can make it in phase 2. Now let's talk about why this structure makes sense for NRIs setting up income streams for their parents. First, clarity of taxation. Since 2020, what we used to call as dividends are taxable in the hands of investor in India. So if your parent is the investor, the tax happens at your parent's slab in India, not yours abroad. Second is control over liquidity. Unlike a property where you can't just sell one bedroom when you need cash. Mutual fund on the other hand lets you redeem a small slice if you ever need an emergency top-up. If at any point the distribution pattern changes or becomes inconsistent, you can switch on relying from fund distribution to a systematic withdrawal plan or SWP. Don't worry, I'll explain the difference in a moment because this is where most people get confused. Let's quickly clean up these two terms in simple language so there is no confusion. IDCW reinvestment simply means you didn't take that money in cash. Instead, you let the fund buy more units for you automatically. Growth simply means there is no periodic distribution. The fund's NAV reflects gains and losses and your unit count stays the same unless you invest more. In real life, if you compare growth versus reinvest, the total portfolio value can end up similar over time because it's the same underlying fund behavior. However, the big difference is psychological and practical. Reinvest build your unit count steadily, which can line up nicely with a later income phase. Growth keeps the unit count static and let NAV carry most of the growth. Neither option is magical. They are just different roads to the same destination if you are patient. So what exactly happens in phase 2 now? So phase 1 was your accumulation phase and phase 2 is your income phase. After 2 to 3 years of calm accumulation, no panic, simply flip your setup from reinvestment to payout. That means the per unit distribution that used to buy more units now lands into the bank account every single month. So if your unit count has grown well in phase 1, your monthly credit can be meaningfully higher than what it would have been on day 1. That's the quiet compounding you engineered. And because you chose moderate, diversified funds and gave it time as well, you didn't need to time the market or chase the latest flavor. Let me ground this with plain numbers so the idea becomes tangible. Imagine you start with a lump sum of 50 lakh rupees in India. You don't need to promise anybody a fixed return because in markets nothing is guaranteed, but you do need a sensible monthly range to plan your monthly income. If the funds you chose deliver, say, a reasonable long-term blended outcome of 8 to 10% band before cost and taxes over many years, you are being realistic, not dreamy. In your accumulation phase, that is phase 1, in the first 2 to 3 years, you reinvest any distributions entirely. So your unit count climbs, your total value will move with the market, sometimes up and sometimes down. But the best part is that your unit base keeps thickening. At the end of the accumulation window, when you finally switch to payout, the per unit distribution, whatever the fund declares, now applies to a larger unit base. That larger base is what gives you a better monthly credit. Now let me address the single biggest misunderstanding that leads to frustration. Distribution from mutual funds are not guaranteed pensions. A fund can change or skip a distribution if markets are stressed. That's why it's recommended that you diversify across 2 funds, and that's also why I want you to keep a backup plan. You can still set a small sensible monthly redemption from your accumulated units. The benefit of relying on distributions is simplicity and tax treatment as income. The biggest benefit of SWP is control, because you get to choose the amount and date, and you can adjust it if the markets are volatile. Having said that, the risk of an SWP is that if you set it too high, higher than what your portfolio is earning over time, then chances are that you will eat into principal. So the art is to set your SWP at a conservative level, renew it annually, and give your portfolio enough time to breathe. As an NRI, you must also think about account titling and practical flaws. If the money is meant to support your parents, invest directly in your parents' name using their resident bank account, and make sure the KYC is updated. That keeps taxation in India under your parents' profile, making the monthly credit clean, and simplifies life if something happens to you abroad. Also add your nominations properly. Always keep copies of PAN, Aadhaar wherever required, and a simple 1-page instruction note at home so your parents exactly know what to expect each month. I also wanted to call out something subtle but very important: sequence of risk. If your first income year coincides with a bad market, your portfolio may wobble. You don't want your parents to feel that stress. So here is a smart buffer that professionals use. In the last 3 months of phase 1, before you switch the distributions to cash, build a cash buffer of 3 to 6 months of the expected monthly cash out. You can do this by either temporarily directing distributions to your bank or by keeping a small liquid fund alongside. That buffer ensures that your parents keep getting that monthly payouts, even if distributions dip or market is too bad. Let's compare fixed deposit to this structure so you can make a grown-up decision. Fixed deposits are very simple instruments, but the problem is that the rate you lock up today might not keep up with inflation, and moreover the interest is fully taxable in India. On the other hand, mutual funds introduce market movement, yes, but they also introduce 3 superpowers you don't get with FDs: rebalancing between equity and debt inside the fund, the ability to adjust your income via either redistribution or SWP, and the option to partially access money without breaking the whole instrument. If safety is your only goal and volatility will keep you awake at night, you can consider keeping a small portion as FD or emergency buffer, and use funds for the income layer above that flow, so that way your parents can sleep better and so will you. A few people also asked me, should we go with growth and do SWP from day one, or should we do reinvestment first and then switch to payout? So here's my honest balanced take. If you need income immediately, growth plus SWP can be fine, provided you set a conservative SWP rate, say 3 to 5% annualized, and make sure you review it annually. On the other hand, if you're okay to wait for next 2 to 3 years and don't need an income immediately from day one, in that case I prefer a reinvestment first, because it pushes you to build a large unit base without temptation. And when you finally turn into the payout, the credit often feels more comfortable. I know someone is thinking, and I might get a comment saying, why not just buy a small rental property and take rent as income? See, property can work, but compare like for like. When the tenant leaves, income suddenly goes to zero until the new tenant comes in. Repairs often show up at the worst time. Moreover, liquidity is very poor. For many families, a core property that they already own plus a market-linked income portfolio offers a better blend of stability and flexibility than adding a second property purely for rent. So I personally feel it's better to put a right mix of your parents' temperament and your own bandwidth. So the idea was to build a monthly payout income stream for your parents. And we can achieve this in 2 phases. Accumulate quietly for 2 to 3 years with reinvestment on, building a thick unit base across 2 complementary funds. Set up a cash buffer at the tail end of the accumulation phase. Then flip to payout when income is needed, and rely on distributions as a first line with SWP as a controllable backup. Title the investments correctly in your parents' name, and review once a year without tinkering every month. That simplicity is exactly why it works. So if you are an NRI and this episode gave you some clarity, take 3 simple steps this week. First, decide the target monthly number that your parents actually need. Second, decide your accumulation window. It can be 18 months to 36 months, whatever works for you. Third, list down 2 suitable conservative complementary funds across diversified schemes you understand. Complete KYC and nomination for your parents and start. I hope you enjoyed watching this video. If you did, then please leave your comments and suggestions. So this is all I had to cover for this video. I'm going to see you soon in another superb interesting video. Till then, please stay tuned to NRI Whiz. Take good care of yourself. This is me, Pratik, signing off from NRI Whiz. Over and out.